What if I told you there's a company that most people think of as their grandparents' phone stock, and yet it's quietly sitting on a 10% free cash flow yield, a brand new product launch, and a fiber expansion plan that could reshape the entire telecom landscape? That company is AT&T.
It's one of those names Wall Street loves to have an opinion on. Bears see a debt mountain, bulls see a cash flow machine trading at 8.5 times earnings. Both sides have receipts.
Today on Charged Alpha, we're diving deep into ticker symbol T, AT&T Incorporated, to figure out which side has the better argument. This is episode 107. Let's get into it. So let's set the stage. AT&T is one of the largest telecommunications companies on Earth, headquartered in Dallas, Texas. They've got about 140,000 employees, and the company traces its roots all the way back to Alexander Graham Bell and the founding of American Telephone and Telegraph in 1885.
Today, though, the business looks completely different from the old Ma Bell days. The communications segment is the revenue engine, wireless voice and data, broadband fiber, and enterprise solutions for businesses and government. They also have a Latin America segment running wireless in Mexico under the AT&T and Unifon brands.
The wireless side operates under AT&T, Cricket, and AT&T Prepaid for consumers, plus AT&T Fiber for broadband. And the enterprise business is actually bigger than people realize. Cloud, security, managed services for some of the largest organizations in the world.
What's critical to understand is that AT&T went through a massive identity crisis. They acquired DirecTV, then Time Warner, tried to become a media conglomerate, and it didn't work. They've since divested those assets and refocused entirely on connectivity, wireless and fiber. That strategic reset is the whole thesis now.
And the timing matters. AT&T just launched a product called One Connect in late March, a single subscription that bundles your home fiber internet and wireless service under one monthly bill. Simplicity as a product, basically.
It's a convergence play. 42% of AT&T Fiber households already subscribe to AT&T Wireless. Those bundled customers churn less and spend more. If One Connect accelerates that flywheel, you're looking at structurally lower churn and higher lifetime customer value across the base.
On top of that, they're racing to hit 40 million fiber locations by year-end 2026, up from 32 million at the end of 2025. And the long game is 60 million by 2030. This is a company spending $250 billion on U.S. infrastructure over 5 years.
The competitive moat here is threefold. First, the sheer cost of replicating a nationwide wireless and fiber network is prohibitive. Second, the convergence strategy creates a self-reinforcing ecosystem. And third, AT&T holds the exclusive 25-year FirstNet contract, the nationwide first responder network, supporting over 7.8 million lines with federally backed capital. No one else has that deal.
All right, let's talk about the person steering this ship, John Stankey. He's been CEO since July 2020 and was elected chairman of the board in February 2025. This is a guy who's been at AT&T or its predecessor companies since 1985 when he started at Pacific Bell.
Stankey's resume reads like a tour of every major function in telecom. CIO, CTO, Chief Strategy Officer. He held all of those roles through the SBC and AT&T merger era. He also ran Warner Media from 2018 to 2020, which is where some of the skepticism comes from.
Right. During his time overseeing the entertainment unit, satellite TV subscribers dropped from 26 million to under 19 million. That spooked Wall Street. But since taking the CEO chair, he's done a complete 180, unwound Warner Media, sold off DirecTV, and refocused the entire company on connectivity.
Analysts now credit him with executing one of the largest corporate turnarounds in telecom history. The proof is in the cash flow trajectory and the stock price recovery. He has a BBA from Loyola Marymount and an MBA from UCLA. Not the flashiest pedigree, but the operational results speak for themselves. Let's get into the financials because AT&T's numbers tell a really interesting story right now. The stock is trading at $26.84, giving you a market cap of about $188 billion. Trailing PE sits at roughly 8.6 times. That is cheap by almost any measure.
8.6. For context, how does that stack up?
The S&P 500 average is somewhere around 20 to 22 times. Even within telecom, T-Mobile trades at over 20 times, so AT&T is priced like the market expects problems or at minimum, very low growth. The price-to-sales ratio is 1.5, price-to-book is 1.774. None of these scream expensive.
What about revenue? Is the top line actually growing?
Trailing 12-month revenue comes in at $125.6 billion. Q4 2025 was the standout quarter at $33.5 billion, up from $32.3 billion in Q4 2024. So you're looking at low single-digit growth, roughly 3 to 4% on a year-over-year basis.
Not explosive, but for a company this size, it's steady.
Exactly. And the margin profile is where it gets more interesting. Gross margin is nearly 84%, which sounds astronomical, but that's a function of how telecom companies report cost of revenue. Operating margin is 18.8%, and net margin is 17.4%. Both are healthy for the industry.
Talk to me about cash flow, because that's really the bull case in a nutshell.
Trailing 12-month operating cash flow is $40.3 billion. After $20.8 billion in capital expenditures, free cash flow comes in at $19.4 billion. That gives you a free cash flow yield of about 10.3% at the current market cap. That is exceptional.
And the quarterly trend?
Free cash flow ran $4.8 billion in Q1, $4.9 billion in Q2, $5.3 billion in Q3, and $4.5 billion in Q4. The slight Q4 dip reflects accelerated fiber capex spending, but the full-year trajectory is clearly upward. Management guided for $16 to $17 billion in free cash flow for 2026, which builds in the heavier investment pace.
Now the elephant in the room, the balance sheet.
Total debt stands at $174 billion against $110.5 billion in equity, giving you a debt-to-equity ratio of 1.57. Net debt is about $156 billion. Cash on hand is $18.2 billion. The current ratio is 0.91, technically below 1, meaning current liabilities exceed current assets. That's not unusual for telecom, but it's not comfortable either.
So what's the deleveraging path?
Management is targeting a net debt to adjusted EBITDA ratio of approximately 3 times by year-end 2026, down from about 3.2 times after recent transactions with Lumen and EchoStar. They're using free cash flow after dividends to chip away at the debt stack. It's a marathon, not a sprint.
And the dividend?
The yield sits at about 4.1%. It's been stable. They cut it once back in 2022 when they spun off Warner Media, and since then it's been maintained. The payout is covered by free cash flow, so barring a major downturn, the dividend looks safe. Overall, AT&T's financial health is solid. The company generates over $19 billion in annual free cash flow, margins are stable, and the fiber expansion is gaining tangible traction. The key variable is whether management can deleverage on schedule while maintaining fiber investment velocity.
So what are the analysts saying about AT&T right now?
The consensus is a buy. Out of about 25 analysts covering the stock, 16 rated a buy, 9 have it at hold, and 0, nobody has a sell rating. The average price target is $30.82, which implies about a 15% upside from current levels.
And the range on those targets?
The low end is $25, the high end is $36. So even the most bearish analyst on the street isn't calling for meaningful downside, they just don't see much upside either. The most notable recent call was Citigroup raising their target to $31.50, specifically citing fiber build-out momentum.
Any dissenters?
Wolf Research downgraded to peer perform back in December 2025, essentially saying the easy money has been made. Goldman Sachs maintained their buy, but pulled the target down to 29, citing caution on the debt refinancing timeline, and Scotiabank has been sitting at sector perform for months. Comfortable, but not excited.
What about the most recent earnings?
Q4 2025 reported on January 28th. Revenue came in at $33.5 billion, beating estimates. EPS was 53 cents, also a beat. The forward guidance was the real headline. They laid out adjusted EPS of $2.25 to $2.35 for 2026, which implies a forward PE of roughly 11 to 12 times. Not cheap for a slow grower, but not stretched either.
All right, let's lay out the bull case. If you're long AT&T, what's the pitch?
Give me the bull first, since I know you've been itching to make it.
The pitch starts with fiber. AT&T is adding 8 million fiber locations in 2026 alone, and every one of those new fiber customers is higher ARPU and lower churn than a legacy DSL subscriber. The total addressable market for fiber is massive, and AT&T has a first-mover advantage in the Sun Belt and Midwest.
Fair point. What else?
Second, One Connect. Bundling fiber and wireless under one bill is elegant. It lowers churn, increases switching costs, and drives cross-sell revenue. 42% of fiber households already take wireless. If that number climbs to 50 or 60%, you're looking at a structural improvement in the unit economics of the entire customer base. Third, the FirstNet contract is essentially a government-backed annuity, multi-billion-dollar revenue stream with minimal competitive risk for the next 2 decades. And fourth, the valuation, 8.6 times earnings with a 10% free cash flow yield in a market where the S&P trades at 20 plus. There's a lot of bad news already priced in.
Okay, now the bear case, and I'll be direct. The biggest risk is the debt. $174 billion in total debt is not a rounding error. If interest rates stay elevated or tick higher, refinancing becomes more expensive and the deleveraging timeline stretches out. That constrains everything: buybacks, dividend growth, M&A optionality.
What about the growth picture?
That's risk number 2. Revenue growth is in the low single digits. The wireless market is deeply penetrated. ARPU expansion is hard when consumers are already paying $100+ a month. And the fiber build-out, while compelling, requires sustained multi-billion-dollar annual capex. If subscriber uptake slows, say because of a recession or intensified cable competition, you're spending heavily without the offsetting revenue growth.
Regulatory risk?
Always a factor in telecom. New spectrum auctions, data privacy legislation, potential antitrust scrutiny, these create compliance costs and strategic uncertainty. And then there's the tariff angle. If broad tariff regimes persist, equipment costs for network buildouts go up, and consumer device pricing could dampen upgrade cycles. It's not a first-order risk, but it's a backdrop worth watching.
Let's see how AT&T stacks up against the other big names in telecom, Verizon and T-Mobile.
Verizon trades at a PS of about 1.46, nearly identical to AT&T's 1.5. But Verizon's PE is higher at around 11.7 times, and their operating margin is slightly better at 21% versus AT&T's 19%. Where AT&T wins is gross margin, nearly 84% versus Verizon's 56%. Verizon also offers a bigger dividend yield at 5.7%.
So Verizon is the yield play and AT&T is the value play.
In a simplified sense, yes, they're running similar strategies, fiber expansion, convergence, but Verizon is further along in some markets and has a slightly cleaner balance sheet. Revenue growth for both is around 2 to 4%. The real outlier is T-Mobile. They trade at a PS of 2.5, nearly double AT&T, and a PE above 20. Revenue is growing over 11% year over year.
T-Mobile is clearly the growth horse in this race.
They are. They're still absorbing Sprint synergies, gaining share aggressively, and the market is rewarding that with a premium valuation. The trade-off is T-Mobile's dividend yield is under 2%. So if you're an income investor, T-Mobile doesn't scratch the itch. AT&T gives you the cheapest entry point by far, but you're betting on execution rather than momentum.
Let's check in on what options traders are doing with AT&T right now.
The options flow has been tilting bullish heading into the April 22nd earnings report. On April 9th, call volume surged 54% above average. 96,500 contracts changed hands in a single session. The put-call ratio sits around 0.65, which leans solidly toward calls.
Where's the open interest clustered?
Call open interest is concentrated around the $28, $30, and $32 strikes. Put open interest clusters lower, around 25 and 24. Implied volatility is sitting at the 35th percentile. That's relatively subdued for a mega cap headed into an earnings print.
So the options market isn't pricing in a big move?
Not yet. Low IV heading into earnings could mean the market is complacent, Or it could mean the expected move is small because there aren't many catalysts beyond guidance reaffirmation. Either way, it creates opportunity for anyone with a directional thesis. Options are relatively cheap right now. But as always, options carry unique risks and the flow can shift overnight. It's a data point, not a trading signal.
What about insider activity? Are the executives putting their own money where their mouth is?
Insider activity has been muted and mostly routine. CFO Pascal Desroches was the top buyer over the past 90 days, with roughly 9,900 shares purchased. On the sell side, General Counsel David McAtee sold about 146,000 shares.
That sounds like a big imbalance toward selling.
Context matters here. January 2026 saw 25 insider transactions totaling about $787,000 in value, but most were stock conversions and tax-related sales tied to equity compensation vesting. That's standard corporate housekeeping, not a signal of bearish conviction. There's no anomalous discretionary buying or selling to flag, which in itself tells you insiders are neutral to modestly confident at these levels.
Let's summarize the key risks and the metrics investors should be watching going forward.
Risk number one is the debt load. $174 billion in total debt is the overhang that suppresses the multiple. Watch the net debt to EBITDA ratio. The target is 3 times by year-end 2026. If they miss that, the stock could give back gains.
What's risk number two?
Fiber execution. The company is committing billions annually to pass new locations, but every fiber location needs to convert to a paying subscriber to generate returns. Watch the fiber net add numbers each quarter. Any deceleration in uptake would be a yellow flag. And risk number 3 is competitive intensity. T-Mobile is not slowing down. If they continue gaining share at the rate they did in 2025, AT&T's wireless business faces persistent pressure on net adds and ARPU.
Catalysts to watch on the upside.
The April 22nd earnings print is the nearest catalyst, specifically the fiber subscriber growth and One Connect early adoption metrics. Beyond that, any acceleration of the deleveraging timeline would be a strong positive signal. And longer term, if the convergence strategy drives churn below 70 basis points, that changes the math on customer lifetime value for the entire base.
So, Lana, when you zoom out and look at the full picture, the numbers, the strategy, the competitive positioning, what's the bottom line on AT&T?
AT&T is a company in transition. The old AT&T, the media-confused, debt-laden conglomerate, is gone. What's left is a focused connectivity company with serious free cash flow generation, a clear fiber growth runway, and a valuation that prices in a lot of pessimism. At 8.6 times trailing earnings and a 10% free cash flow yield, the market is essentially saying it doesn't believe the turnaround sticks.
And the key metric to watch?
Fiber net adds. That's the single number that tells you whether the entire strategic thesis is working. If AT&T can consistently add 1 million or more fiber customers per quarter while maintaining ARPU growth, the stock re-rate from value trap to turnaround story becomes increasingly hard for the market to ignore. If fiber growth stalls, the bear case gets a lot louder.
I want to close with a quote from AT&T CEO John Stankey, speaking about the One Connect launch back in March. He said the future of connectivity isn't just about speed, it's about simplicity. One network, one relationship, one bill.
That captures the entire thesis in one sentence. Convergence as a product, not just a strategy.
Simple, right? But making simple work at the scale of 140,000 employees and 7 billion shares outstanding, that's the hard part. And that's what we'll be watching. That's going to do it for episode 107 of Charged Alpha, our deep dive into AT&T, ticker symbol T. And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.